Hello, this is Property Matters, a weekly catch-up on the world of property supported by Fairview International Property Consultancy and auctionproperty.co.uk. And we're live every week on YouTube, Facebook, LinkedIn and our website propertymatterstv.co.uk. If you're watching on our website, please leave us a Google review, and if you're watching on the socials, get involved in the comments section below. Our email address for discussion topics is hello@propertymatterstv.co.uk. There's a podcast version of the show available every Monday at 10 a.m, wherever you get your podcasts from, of course, and you can search Property Matters TV and find us there. Let's take a look at the week's property news with our property expert, Joe Joshi. Hi, Joe.
Hello, Paul. Hello. Good morning to all of our viewers and listeners wherever you are. Good news, though, this week for a change, I suppose. The Bank of England decided to give a little gift, summer gift.
Yeah, it's interesting that, isn't it? So we've had mortgage rates go down from 5.25 to 5. The only thing that I think wasn't set in stone that it was only going to move 0.25% was the fact when was it going to happen? Was it going to be the end of July or the end of August? But it's been the end of July that it happened, and I guess that's going to help a few people and also carry on with that belief that we're going to have a year of two halves, so a very slow first half and a quite lively second half. What's your thoughts, Joe?
Yes, I mean, it all motivates definitely people that have been sort of sitting on the fence in a positive manner. And of course, it will affect the mortgage payments quite a bit. People will see a little difference. So that's quite a good little gift, I suppose. And I'll call it a gift because really we weren't expecting it. They were hovering. You could see that the Bank of England guys were on a tip of the scale of which way, and then the governor of the bank actually tipped the scale by saying yes to the drop. So it was a bit of a knife's edge scenario. But whilst people are on holiday and enjoying the sunshine a little bit of sunshine, not a lot, just a little bit, at least it's something that's positive. And yes, of course, it would be a better half, perhaps, rather than the first half, which has been very, very slow. And of course, it's been slow, Paul, fundamentally for a number of reasons. And one of them was obviously election fever that was coming in. And that meant that everybody was sitting on their hands, waiting to see which way the wind's going to blow.
And of course, the decision between the governor and all the Bank of England members on the Monetary Policy Committee were all sitting there and making their vote. And it was very, very close, wasn't it? So the suggestion is that we probably won't get another cut before Christmas.
Yeah, I think it was definitely a hesitant cut. So I'd be surprised if there was anything prior to Christmas. In fact, I'd be surprised if there's anything prior to the next first quarter of the following year, really, because there's obviously lots of changes coming. So while in one hand the governor of the Bank of England and the Bank of England have given, there's going to be a lot of take on the other hand. And once I always said once the first 100 days or so of the honeymoon of the new regime, we will start to see what really comes out, and that's beginning to come out now. And that certainly will make everybody sort of think twice about, even though there's a positivity, it will still make them think twice about the things that they're going to actually plan going forward. But the positive part of it is that for the property industry, it's definitely good news. Homeowners who have mortgages, variable mortgages, it's definitely good news. And it's not such bad news for those that are still saving, because it's not a dramatic drop, but it's enough to say, that could also change in the future. But for the time being, let's look at the positive that's come out of it. And the positive is that, home ownership will become a little bit more palatable.
Indeed it is. And our first story, as we turned into the new month, means that we have a UK house price index from Zoopla to take a look at. And of course, they are giving us the latest data, which is that annual UK house price inflation for June was 0.1%. Percentage of the asking price achieved on pricing was 96.8%. So basically 96.8% of people got the price that they advertised, and 16% was the increase on the stock of homes versus a year ago. And they're saying this is the most balanced house market in 5 years, Joe. The housing market continues to adjust to 4% plus mortgage rates, with positive signs of increased activity, more sellers sellers continue to list their homes for sale. More sales are being agreed and buyers are paying a greater proportion of the asking price as confidence improves. House prices are rising slowly across all regions and of the UK over H1 2024, reversing the price falls recorded, of course, over 2023. Market activity will continue to improve, but prices will be kept in check by greater supply and affordability constraints. House price inflation is static, still negative in the south. UK house prices edged 0.1% higher, as we just said, over the last 12 months, increasing by just £310 to the average value now of £265,600. Annual price inflation ranges from minus 1.2% in the east of England to 3.9% in Northern Ireland. So still very much the same sort of picture, but the most balanced market. So there's a bit of encouragement, and this was written, of course, before the 0.25% cut. So I guess that's put a little bit of boost in, but we've got the most balanced market with a reasonable amount of supply. People keen to put their houses on the market now. We've got a new government. We know where we're going with inflation, and we should have a better half to the year.
Yes, definitely. I mean, all arrows are pointing in the right direction for now. And yes, the 0.25% is definitely going to help. And of course, the fact that the election is over and done with, that means that there's some sort of stability going forward and seeing where the future is going to be. Also, on top of that, I mean, people like Angela Rayner have been throwing out lots of announcements about planning laws and changes and things that they want to instigate. So all in all, it looks fairly rosy for the property market. And the reason it's rosy for the property market, and we haven't seen the results of that just yet, but I'm sure over the next 3 to 6 months we'll start to see some sort of result, is that it's what's going to drive the economy. We know that you have to build your way out, and that's part of the philosophy the new regime has taken on board by saying that they're going to build 15 million homes, sorry, 15,000 homes, try and do a bit more than that with green belt, grey belt, and any other belt that they can find. So the fact is that it is looking a little bit more positive, but we will be able to tell that in the next 6 months, see where that reaction is.
So the annual rate of UK house price inflation will increase towards the end of the year to plus 2% by the end of the year. That's as the H2 2023 data falls out of the annual growth calculation. So we're losing all that negativity from this time last year onwards now and adding in the more positive amount. So we've gone from negative pretty much in the south here to what will be overall +2 by the end of the year. Modest price rises help motivate sellers to list their homes for sale, but a return to fast house price inflation would be unwelcome right now, and I guess that's an obvious one, and that's one of the reasons why the Monetary Policy Committee decided to vote so closely, because it reminds me of a forest in the middle of summer, and one little match and the whole lot goes up again, doesn't it?
That's right. Yeah, and it's a cautious move. It's a good move, and being cautious is the right thing because we've gone through the ups and the downs, and we had a really good up in the property market, then a complete down, and now it's good to sort of perhaps come out, as Mr. Gove would have said, a little bit more leveling. But I'm not sure how long that leveling would last, but certainly it's in the right direction. It's good to see the positive across the board. So yeah, in generally, I think we're looking in good shape going forward, and they've got it about as right as they can. But like you say, a bit like the match and the woodlands, it won't take more than one match to make sure that the whole thing goes wrong. Equally, you don't want to put a big race on house prices if you can help it, because obviously if those people are within the reach of buying, then it will become out of reach for them to buy. And also the buy-to-let market, which has brought in quite a lot of stock lately, may come back depending on what sort of fixed rates and opportunities they are offered. So all in all, it could be a quite positive time.
So the only real fly in the ointment really is affordability. That's the only negative factor here, because it's the major constraint for us having real sort of house boom time, I suppose, because, especially in the south of England, because the prices are so high and the wages haven't really kept up with the prices over the last few years. The housing market requires really, they're saying, a 1 to 2 year window where income rises faster than house prices to help reset affordability. Incomes are set to rise 4.5% in 2024, and we would also expect incomes to rise faster than house prices in 2025. The OBR says that house prices or house income growth in 2024 will grow by 4.5%, so they're quite bullish, which is an interesting one. I mean, it's almost like we could really do with that extra 0.25% and bring it down to 4.75, but we're saying that we don't think that's going to happen.
I certainly don't think it's going to happen. I mean, it will come down in fixed rates, Paul. That's where you got to see it. So those that are looking to refinance will be able to negotiate, I think, a fairly sound fixed rate, which may be 4.5, 4.75, maybe a bit less, depending on the time and term. And of course, it's the same opportunity for first-time buyers. But the actual base rate, I don't think will change from the 5% for some time. In fact, I was surprised that they actually even changed it now. And to a large extent, those people that are in the property market, most of them were okay with the 5.25. They could see that the 5.25 stays where it is, but allowed people to negotiate a lower fixed rate in order to give them that sort of 3 to 5 year plan. So remortgages, first time buyers, sort of new mortgages, etc., are being offered at lower rates in general.
Yes, the housing market activity graph we have on the screen now for those listening in the podcast, housing market activity running above pre-pandemic level. That's from 2017 to 2019. So that's what they're comparing now to. So the buyer demand is up 20%. Number of sales agreed is at 22%. Flow of new supply is 9%. And stock of homes for sale is 12%. And they're saying that one of the factors is that there are more homes for sale than at any point in the last 6 years. This is improving choice for home buyers and supporting more sales. And I remember when we were going through the pandemic, and even before that, there was just no homes coming up for sale, and we had loads of buyer interest, and of course that was fueling the market, wasn't it?
Yeah, look, the market has its way of being topsy-turvy. Sometimes it's a buyer's market, sometimes it's a seller's market. At the moment, it's kind of stagnant because there is more stock. I'm not saying there's a rush of buyers. The buyers are pretty cautious in what they want to do. The rate has come down to give them some more energy into that. So it might become a seller's market in the next 6 months again, when they start to see that increase in value of their home. And so therefore people won't be able to make reduced offers because people will say, well, actually the market is bullish now, so I don't need to take those offers. And that's what makes the housing market go round. That's how it's been forever and a day. It's it's not winner takes it all. Sometimes it's the buyers and sometimes it's the sellers.
Yeah, the average agent has 33 homes for sale, 16% higher than a year ago, and above the longer run average of 25 homes for sale. So more supply, of course, means more sellers, most of whom are also buyers, motivated to move by a range of reasons. Many would-be movers are upsizers who are looking to go further afield to get the home with the features they're looking for, while also seeking value for money. And I suppose that is a good point, isn't it? Because if you're selling a home, usually you're going to be buying one.
Absolutely. No, there is, and there are many other features of those buying and sellings that do come into play at different times of the year. I won't say what they are at the moment because I think it's unfair to state those sort of obvious points. But yes, from an agent's point of view, those are all good signs for the property market. But I think that the reality is that there is a bit more stock. And of course, positive news like the Bank of England doing what they did is only a good news for those that want to be in property. And of course, people will always want to be in property. This is part of the reason people always want to be in property, Paul, because it's a comfort of knowing that they've got something, that they've achieved it, even if it's owned by the mortgage company for 95% of their borrowing. They still feel that there's something that they can touch and feel and walk in and out of and say it's mine.
Interesting data on the sale of buy-to-let properties in this report as well, Joe. Over 1 in 10, that's 12% of homes for sale were previously rented, a proportion that has held broadly steady over the last 3 years. Tax changes introduced in 2016, of course, greater regulation of rented property and higher mortgage rates have all led to landlords selling, which we know. Not all these homes are, of course, sold to home buyers and leave the rented market. We find, they say, that 40% remain in the rental sector, brought by a new landlord or let out by the current landlord who decides not to sell. So that's interesting, because the houses can go on the market, but sometimes they're withdrawn. So about 40% of them stay in the rental sector, which I suppose still means, if you look at the other side of that coin, that 60% of them are going to, presumably, first-time buyers.
Oh yes, I mean the rental market was slightly decimated from all the taxations and all the legislation that was brought in, and the smaller people, what we called the hobby landlords, if you want to call it that, those are the ones that came out because it just didn't make financial sense for them to stay in with the one or two properties. But the ones that had the portfolios of, maybe 20, 30, 40, 100 properties, they're the ones that scooped up those because they've already got a machinery in place that says, we need that stock. So if somebody wants to sell, I'll take it on because I've got the tenants for it, or they've got an agreement with a local authority, or whatever other means that they're providing those tenants for. So, it's a guaranteed return from them. So yes, there was a shift that went, but it was only a small percentage of that shift. And that small percentage was mostly the people that actually had, one or two properties. And the others have become stronger. So yes, there is a strong point for the first-time buyers still as a percentage, and it's clear that there is a huge appetite from first-time buyers to buy their first home in the UK.
And we have a graph on the screen at the moment, which is the sales agreed, which are running at 22% above pre-pandemic levels. This is an index of sales agreed. And you can see in the second half of 2023 on the right-hand side, where once again, just like in July 20, when we were in the midst of pandemic times, and indeed each year since then, when those mortgage rates really hit, we were back to almost the same sort of level of crisis as we were during the pandemic in the last half of last year. And you couldn't really get two more half years that are concurrent with each other looking more different. So H2 2023, just about everything in terms of house price growth in negative. And now in this first half, even though it's been slow and we're looking for a much more positive second half, everything's pretty much been in the positive. So a real chalk and cheese, black or white, if you want to call it, half of last year and start of this year. Looking at some more data in here, buyers are paying a greater proportion of the asking price than they were last year, which means presumably prices are firming up. When higher mortgage rates hit demand, UK buyers are currently paying 96.8 of the asking price, and last year it was 95.4 as late as last November. This is on par with the long-run average and points to continued house price inflation. In value terms, this means 16,600 below the asking price for sales agreed in June 2024, compared to 23,000 below the asking price in October 2023. So there's less discounting going on, and I guess that's because of the optimism.
Absolutely, not just the optimism, but just generally, if there is an upturn, which you can see from the two halves of last year, 23 to 24, it just gives the sellers that much more confident that they are, going to stay steadfast in trying to achieve the prices that they want to achieve, as opposed to having to panic sell because they need to sell. So yeah, overall, it is a good thing for the market. I just hope that it doesn't run away, as you rightly say. If people start to sort of get over enthusiastic about buying, and the mortgage rates continue to come down, for argument's sake, house prices will go up, and then that difference, that gap, will just become huge again. And that makes it impossible for first-time buyers, and they are very crucial to everything we do. If we don't get a chance for the first-time buyers to be on the ladder, then the rest of the ladder is not going to be climbing.
Their outlook for H2 this year is, to be honest with you, probably one of the most positive I've read since we've been covering the Zoopla reports on a monthly basis. They say we expect continued modest growth in the house prices, which will be greater outside the south, of course, where affordability is less of a constraint on price inflation. Sales remain on track for 1.1 million in 2024, still 10% lower than the 20-year average. The timing of the first base rate cut was important, of course, and that will deliver a boost to consumer confidence and market activity. But there's nothing, they say, in the King's speech or the new government's plans that has any material impact on the outlook for the market over the next 12 to 18 months. Economic growth, they say, and increasing home building will benefit home buyers and renters in the long run. However, affordability and access to home ownership and rented housing remains challenging for a significant proportion of households on lower incomes. And I suppose that really is the battleground, isn't it? And that's the one thing that successive governments have failed to tackle. And that's the one thing that I really worry about, because I've heard nothing but the same rhetoric from the new party in power about, rogue landlords, and that's the solution to the rental market. Well, it clearly isn't, because nobody can make up their mind whether they need institutional landlords or private landlords or, as you put them earlier on, hobby landlords. And until we understand what the rules are and what the government wants and how we can sort of somehow bring a standardisation to that private rented sector, we're just going to be in this muddle, I would have said.
Yes, I mean the problem with this landlord business is that they just didn't have an alternative form of investment. That's what brought them into the market in the first place. So if they had, I mean, the interest rates were so low that they just didn't get a good return on their investments. If they had a 50 or £100,000 saved in a bank account, it was not doing anything really. So they became, as I would say, hobby landlords. They bought an opportunity or a doer upper or something that they thought they can rent out and subsidize their income by saying, okay, well, I'm not going to get a steady interest rate income from my savings, so I may as well go into the property. And they had two scenarios with the property. One was capital growth, and the other one, of course, was rental income based on what they were doing. But most of that went out over this same period, and that was driven out by all the problems that they created in the rental market, and especially in the private sector, for all the legislations and all the potential laws that they could bring in. Landlords ran out in droves, really. But the government, whether it's the previous government or this government, would have lost out and will lose out tremendously, because they've now got to put their accelerator down fast to try and build lots and lots of houses, because they are the ones that took away a good percentage of those houses. Not they, i.e. the current government, but the government in general, were the ones that had those law changes that made the private renting sector landlords run from it and thought, you know what, this is actually not viable anymore. And then when the interest rate went up, the base rate went up, they all went, okay, well, it's actually cheaper for us to get rid of our buy-to-let, take whatever money out of that, have no headache, nobody phoning me up and saying, I've got a leaky tap, and I can go to a cruise and earn the money, on a fixed rate, and have no headache. So, it's the government's fault that it made everybody run from that. The pluses and the minuses, the pluses are the stock is more available. So it gives a good chance for first-time buyers. And because the landlords were out of the race for buying a property, it meant that the first-time buyers could negotiate a better price. Otherwise, the renters, the landlords, and the first-time buyers were always running parallel and racing against each other, because they were both vying for the same property. So the first-time buyer wants a cheap 1 or 2 bedroom flat, and so does the investor. The landlord, he turns around and says, well, actually, I've got the cash, or I'm in a position to buy this. I'll buy that at this level, because I can rent it and have a return. So those are all the reasons, and they're not going to go away. They are still going to be there, and the government will need the private rental sector back, because there's just no way. I mean, I wish them all the best to try and reach the targets of building those houses, but we know historically it's never happened. So I can't imagine what magic wand is going to be waved to build all these houses.
Yes, and even then, when they build that, if they hit the target, they're still nowhere near what they need in reality. But let's move on to a completely different theme within property, and that's one of the things that attracts us to this whole topic, is there's just so many different branches around property. And this is a story about why is it so difficult to sell a flat in a retirement home. Now, we haven't really discussed retirement homes in any real detail, and I thought this was quite an interesting one. I saw this in one of the online newspapers recently, and I thought, well, let's have a chat about this, because it says here, my daughter's recently inherited a McCarthy Stone leasehold retirement apartment in Lancashire and need to sell it to get probate and distribute the proceeds according to the late owner's will. Some of those waiting for their share are in urgent need of the money, but this may take up to 3 years. My daughters have been told as the new owners must be over 70 years of age and demand from this group is low, until this is done, they cannot distribute the assets, all the while incurring an annual service charge of $8,500 a year. What can they do? Well, that's an interesting one, isn't it? And let's broaden that topic out rather than necessarily just McCarthy and Stone. But of course, more and more people have been moving into these I would say not necessarily all, totally assisted, but they've got the sort of the bell and they can contact someone if they need them, or they've got varying degrees of support in all of that, of course. So, but they generally are small flats within a larger concern, aren't they?
Yes. So over the years, a number of operators have emerged, including obviously McCarthy Stone, who are probably a household name, and similar others have arrived in the marketplace all over the country, all over different places, and they have a criteria. The criteria is normally within certain facilities for those that are able to go out and move around. So they've got to be within a short walk to a bus stop, local shops, access to the town centre, and all those communication scenarios, so that it gives somebody a chance to say, okay, well, look, I am in an assisted living, but I want my independence. And that's what it is. It is independence. These flats are fundamentally 1 or 2 bedroom apartments within a block complex. And the only restriction really is the age factor. And that's what makes them attractive in some purchases for those people, and it also makes it attractive for those that need assistance. So if you've got an elderly parent that is living on their own, something like this works really well, because they've got that community feeling, they've got a communal area within those complex, be it a living room or a TV room or whatever they want to do, some sort of restaurant area. All of those things do exist. So actually, they conjure up quite a nice environment. You're absolutely right, and this lady is absolutely right about the restrictions and the problems it causes in terms of who is going to buy, because those people at the other end of life, at sort of 60 plus, are in a difficult situation in a number of ways. They either are in a big house and just cannot see themselves downsizing, are healthy and wealthy and don't wish to be amongst a complex. And then there's the other side of that Richter scale, who are not so well and require the help, and maybe don't have as much money and will look at these sort of things. So there's a huge plus for these things, and there's also a huge minus. Now, we had a couple of these properties on the market over the years, and it was always quite frustrating. And I share the frustration of the lady that writes in the article. And that is that, you had to sell to someone that was at a certain age or above. It couldn't be anyone younger or whatever. And recently I looked at that for a client, and I discovered the following, which is actually not highlighted, but I did find it in McCarthy Stone's documents about what can and cannot happen, and who can and cannot buy these types of properties. So to elude those that haven't actually looked at it, anyone, I quote, anyone can buy them as an investment, so that they can be rented out to potentially someone who is on the age restriction. And that could be on the basis that it is 60, 65, 55 plus, or 70, depending on what they qualified for in that planning, in that town, at that location, at that time. But fundamentally, if you and I decided that we wanted to buy, and I'm actually already over 60, so I qualify whatever happens. But if I wanted to buy a property for my parents to live in, and I was a younger man at the age of 40, 45, I could have bought this as an investment and then put my parents in who actually would have qualified and they were over 60 to live in it. The fundamental is that the people that are occupants of the property need to be compliant. They need to be at the age that is set out by the planners and generally for all those people. Now, I know that a lot of people don't actually know that because I've sold a few of those and I had to dig around and get some investigation because it was becoming a bit of an issue. So I thought there must be a reason, or there must be a way around it. And the way around it is you can, and they clearly point it out in their on their website, in their status, that they don't have any objections to somebody buying it. It's just who the occupant has got to be. That said, they are a really good investment because you're buying them at silly prices by comparison, because most people are not buying them. And the only caveat that they have in them is a huge service charge. Now, the huge service charge is expensive, no doubt about it, but it is because it offers all the facilities. It's got a 24/7, 365 warden on site, maybe two, who've got to be paid for as a salary. It's got all of the services, including communal areas, restaurant, games, gardens maintained, and so forth. So it is relatively at a high end. So you pay what you get for, but basically, and you're getting a good service, security for your parents or security for the elderly, with someone who is on site, available 24/7 to cater for their needs, i.e., tugging the bell in their room or anything that is there. So, I suppose you've got to look at it the other way, and that is that if somebody was to own a property and didn't have that and found that, the parents were not in a good position, they'd either have to pay for somebody to go and nurture them and nurse them, or they'd have to put some sort of monitoring system in, and they're all costs and time. And getting to them in the time from wherever they might live to their call may not be as successful as perhaps somebody who's living in a McCarthy Stone type of complex. So it's a good endorsement for McCarthy Stone as a brand and as a product. It's at a price, and the price is because you're providing that service. Now, when somebody inherits that property, sorry about going on, but I actually done some homework on this, so I know what your question was. So you now are impressed with me. I know, I can tell, Paul, that you didn't expect me to give you all these answers. But so the reality of it is that when it comes to selling, most people don't know, and when it comes to inheritance, they inherit a property which has got service charge costs. So they don't allow for that. They think, well, I'm going to get £100,000 and there's this, that service charge is across the board. And the easiest way and the quickest way to mitigate that really is to rent a vacant property. But some properties have lied empty because they don't know that they could actually rent it out to someone else. They assume that it has to be sold to someone of that age. And thus, the agents that they employ are also not au fait with that situation. It is only that I happen to dug this out because of the information I was requiring. So I'm now sharing that you shouldn't have a difficulty in selling, and this lady should have stuck it on the market and offered it as an investment, and an investor would have got a renter in there. And if you're looking at a very nice luxury apartment in that complex at £100,000, where you can't buy a first-time buyer property at that, but yes, your tenants are gonna come at an age, and some of those tenants have sold bigger properties, so they actually have the money, but they just don't want to buy, so they might just rent for a short period. I hope that was helpful.
Yes, indeed. I mean, they do say they gave some lawyers' advice in the article, and they said exactly as you said. You really need to check the details of the terms of the lease to see if there is an option for the builder to buy back, or alternatively to sublet. Of course, that's the other thing. And the fact that you've added in the fact that they can rent that out is a helpful one, particularly in the time when it takes for the probate to take place, which can be anything up to a year. They could have at least maybe tried to rent it to someone of a similar age. They also suggest that actually there are specialist estate agents that deal with this kind of transaction. And in some cases, some of these landlords even have their own resale service. So there is the option to do that. I guess the challenge for this particular lady was the fact that she had a group of family members who were all in urgent need of cash, and they needed to dispose of really quickly. And obviously they were then still faced, while they couldn't do that, with £8,500 worth of bills every year.
That's right, and that's what I'm saying, that had they been advised and guided correctly, what they could have done is, whilst all of this was going on, they could have continued to market the property and at the same time rented it out. They would have had to provide the appropriate amount of notice. But most of these complexes have not just one or two empty properties, sometimes they have more than that. So it's a lot easier for someone to move within the complex to another one if one did get sold. The other point is, if they're all on the market to sell, it's like a supply and demand thing. Then of course the choice is vast, and the buyers are limited, and so subsequently you're not going to sell them as a quicker. So sometimes I think it's always worth talking to the others and say, look, can we not do this piece by piece? Let's get one gone, and then we can talk to another one on resales. But different people, different places, different parts of the world, different circumstances.
I guess the point there is get some advice if you're not too good on reading the small print, but otherwise definitely read the small print. And on that note, we shall leave it for another Property Matters. See you again soon.